Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us is Brian Stutland, managing partner at Equity Armor Investments, as well as Mike Khouw, CNBC contributor and chief strategist at OpenInterest.Pro. We're here to discuss if Capex-Led Optimism from big tech, AI, automation, robotics, if that's going to be the escape hatch from economic stagnation. It's great to see both of you as always, Brian. And really, the concern here is global trade anxiety, the conversation around tariffs, and if these particular groups are going to be the ones to continue to drive the market. Before we get into those sectors specifically, I want to take a look at the VIX. Anything that you can see from the volatility perspective in terms of how market participants are thinking?
Well, it is kind of interesting because we are getting one worrisome cue from the VIX, and that's the fact that I don't like seeing when the market is up and reaching new all-time highs. Let's take a look at the Nasdaq, for example. If you look at the charts here and what the VIX and volatility, the fear factor, what people are saying. When you look at that, the Nasdaq making new all-time highs and the VIX making higher lows. Like in other words, so volatility is starting to creep higher. There's people buying insurance into this rally at all-time highs. That sort of metrics should be opposite to each other. We should see the VIX falling. We should see fear dissipating. We're not really getting that right now. And so that's a little concerning to me that people are so wanting to own insurance and downside protection. And yet the Nasdaq sitting here at near all-time highs. And yet people are starting to get a little bit more fearsome. So I think some of these things you mentioned before are getting people worried about where we're at in terms of a valuation standpoint.
Right. And of course, Mike, tariffs, you have to think about that when you're, the corporate balance sheets and how it's going to impact margins. Will it be absorbed in the supply chain? Is it going to be absorbed by the customer? What's the bigger picture here? What's the takeaway? Are we potentially heading into stagflation territory?
Well, I certainly hope we're not heading into stagflation territory. I mean, the good news, I would say, is that, the Fed has maintained, I think, a pretty steady hand here. They don't seem to be bowing to pressure. They don't want to sort of relive the Arthur Burns era of the central bank, and that's certainly not something any of us want. I think it's very interesting what Brian was pointing out, also that we're trading at all-time highs, and that we are seeing those higher lows in the VIX. Those of us who managed to live through the tech bubble will remember that it was one of those curious things that we actually saw in late 99 and early 2000, that the market was reaching new all-time highs, and yet volatility was creeping up. So that essentially, the way I like to think about it is, investors are like a bunch of long-tailed cats in a room full of rocking chairs. They're very, very skittish and jumpy and a little bit worried about what's going on. On the tariff front, it's interesting. So Sigma, a Japanese company that makes optics and a bunch of other things, they had increased prices by 10% to account for the prior tariff amount. Then the most recent agreement that we reached with Japan has a 15% tariff. They decided they were not going to change prices to maintain their relationships with dealers, to maintain their relationships with customers. Now, not every business is going to be able to absorb. That's the word that company was using. The higher tariffs. But I think that there's a couple things going on here, and some issues that if you raise prices too much, it's actually going to really hurt your business, and these companies are aware of that risk.
Yeah. Well, Brian, let's talk about seasonality for a moment here as well. When you look into volatility coming up in Q4 or even early 2026, we know August, September, October tend to be more volatile times in the market. What are your thoughts, going into Q4 and then 2026?
Yeah, I mean, that's a great point, Jill, because one thing you could look at and say, oh, well, the VIX is making higher lows, but maybe it's seasonality, right? September, October are typically volatile months. Option traders like owning options going into those months because you usually get a higher level of price movement back and forth in the market, where you see that sell-off in September, and then maybe that Q4, November, December, Christmas rally that kicks in, and it's almost, you get that V-shaped return. So it's not unusual to see people wanting to own options into this seasonality event. But we are seeing that when you look at the S&P 500, we are seeing put buyers increase. In other words, the price of a put relative to the same price of a call, like let's say 25 deltas or a couple percent out of the money, people are wanting to own puts right now. That skew is shifting towards the put buyers. We're seeing more aggressive put buyers. So certainly there's some, like I said before, level of protection that's going on that they want to sort of, whether it's playing the seasonality trade that you typically see in September, October, or there's maybe some underpinning concerns. To Mike's point, if companies can't raise pricing and they need to sort of maintain those relationships, what does that do? That cuts into profit margin, and then now you've got systemic risk.
Yeah. But Mike, there are fundamental bright spots here, right? We're seeing massive capex from the tech giants, Amazon, Microsoft, NVIDIA. Can this investment boom in AI and automation, robotics, can that really help us avoid a full-blown, economic stagnation?
Well, I think there's two things that are a real benefit as far as that big capex is concerned. So the first of that is, of course, that if you're just taking a look at the top line revenues and profits for the largest tech companies, those are doing well. So consequently, their equities are doing well. That improves the wealth effect. So there is sort of a reflexive benefit to that. The other thing is, let's just take a look at earnings in the S&P since July 1st. About 80% of the companies that have reported since then have beaten on the revenue line, and by an average of about 6.2%, which is pretty good. If you take a look at the adjusted EPS growth for those companies that have reported since July 1st, we're looking at numbers that are close to 12% year-on-year EPS growth. So that part is all very good. I think your point about consumer confidence, because it is about 70% of the economy, is the thing that I'm most concerned about, because the few areas where we're struggling to essentially beat the survey numbers are on the sentiment side. And we are seeing some weakness. We're seeing some home price adjustments down. I think that is reflective of that. So there is some indication that there is some pressure amongst consumers. And I think basically we've completely erased all of the benefit of transfer payments that took place in the pandemic and immediate post-pandemic period. And we're going to need to see some, basically bolstering for consumers essentially to support that part of the economy.
Brian, do you think markets are buying that story though? Do you think this is like 95 or 99 in the valuation cycle of tech? Do investors stay invested, or do they hit eject? I mean, there is going to be fallout with any iteration of tech. You get more scale, you get more competition. There's going to be winners, there's going to be losers. Does it feel like 1999? Do you think investors have learned, or are they being more particular in terms of where they're allocating resources? What are your thoughts there?
Yeah, I've gotten that question lots from my clients. And, Mike made some points on valuations, that the valuations maybe aren't that far stretched like they were in late 99. There's actually two things really going on when you try and make that comparison, right? Number one, at the end of 99, let's remember the Federal Reserve was actually raising interest rates. We're now in an environment where the Trump administration wants them to cut interest rates or increase liquidity into the system. So we're kind of in an opposite environment in that. Now, the second point that we had is really this over exuberance, right? We had the pets.coms of the world coming to market. And were they really providing increased productivity? I'm not so certain. AI right now is increasing productivity. We're going to be a US manufacturing type country. We're going to need automation, robotics, and more efficiency, better productivity. And this technology is doing that versus the 90s. So we might still be in 95 or 96, despite some of the warning signs I mentioned earlier in the show about the level of volatility and the concern. Maybe it is just seasonality, and we're still in this boom era of this new technology and more like the fourth or fifth inning rather than late 99, which was really the ninth inning and getting close to the end game.
Well, Brian, let's talk about technicals for a moment here and what you're seeing in terms of price action, right? What technical and fundamental signals are you seeing in the Nasdaq 100 as an example right now, which is the home of the Mag 7s?
Yeah, I mean, let's take a look at the chart there. And if you look at the NASDAQ, really, levels right around 22,000. We saw that breakout in May and June. And we saw this sort of gap up in the NASDAQ 100. And so it kind of looks like, let's say 22,000, call it 500 area, just above that, should keep acting as support here. If the bull market is still intact, that should act as sort of a support level to the upside. Now, could we get a little pullback here where we're maybe a little lofty? We've tried to sort of make through all-time highs and we couldn't quite get there. I think we need some sort of catalyst event. Maybe that's the Fed rate decision in September or whatnot. Maybe that's earnings in late October of the next cycle. We're going to need a catalyst sort of to get up. So I could see us pull back to that support level, but certainly it looks like that 22,500 to 22,700 is an area I would want to be a buyer. I think we hold and then just keep it, maybe I keep a tight stop in case we do cover that gap and get back into that danger zone.
And Mike, speaking of earnings season, how has it shaped your view on where the market goes from here? Or to Brian's point, do we need to wait till Q3 to see what the fallout is once tariffs really do start to hit the marketplace?
Yeah, I mean, that's one of the things. We've had this little kick the can effect, right, with the tariffs because, the on again, off again. We're not 100% sure exactly how these numbers are going to end up playing out. But I have a feeling that maybe the initial concern that we had in that sort of post-Liberation Day washout, that concern, I think, is safely behind us. I don't think anybody believes that those rather eye-watering numbers, I think we can all safely describe it as that the president was holding up on his board on that day. I don't think any of us are anticipating anything like that. I mean, and look, it's our largest trading partners, the EU and Japan, where we seem to have reached some form of an accord. And in many cases, certainly with the EU, the tariff numbers that are being imposed are very much in line with sort of the import duties on things like automobiles, U.S. cars sold in Europe were. So I don't think that they're that unreasonable. There is going to be an impact. I don't think we should deny that. And it's going to be some balance between higher prices, which is a little bit of a risk on the consumer side, a little bit inflationary, and lower profit margins if companies do what Sigma did and decide they're going to absorb a portion of it. But if it's going to be overseas companies that have to absorb some of that, that's not going to be as much of a concern for us when we're looking at things like the Nasdaq and the S&P.
All right. Appreciate your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.